Hey everybody, Dominic Wells here. I'm the CEO of Onfolio Holdings Inc. And I've had a bunch of questions recently about how I think about dilution with regards to the convertible note and the ELOC we have outstanding. So I just thought, you know what, I'm going to kind of do a little bit of spreadsheet video today and walk you through how I think about it and the moves that we're thinking about making. So full disclaimer, I'm not guaranteeing anything in the video is going to happen. I'm not saying we're going to do this and the market's going to respond this way. I don't have control of a lot of those things, and that's not the purpose of this video. The goal is to just kind of show you it's a little bit of like spreadsheet mergers and acquisitions. Like here's what should happen or here's what could happen, but also it's kind of how I think about it. Um, and I enjoy doing these types of thoughts and sharing with people. So I think, yeah, I think it will be really insightful for people. There's going to be a lot of approximations. So, for example, I'm not going to use our exact share count in the spreadsheet. I'm going to round it up to the nearest number that makes sense. Um, if I'm talking about what kind of multiple the market might assign us, I'm going to use a round number. There's no real way to know what kind of market the multiple is going to assign us until that happens. So don't take everything in the video as a fact. Don't take it as a promise or a prediction. You know, public companies, we can't do stuff like that. But the purpose of the video is to say, like I just said, here's how I think about it. Here's where it would be really accretive to shareholders as we raise equity and issue more shares. And and yeah, and I think it is very interesting as well because some people don't really know how this works or how it should work. Some people probably they know, but they don't necessarily know how I'm thinking about it. And others probably know how it should work, but want to know that I know how it should work. So that's the purpose of this video. Ask any questions below. You can email me as well, or follow me on LinkedIn or Twitter or something. And I'm going to jump into the screen share now. Okay, so I'm going to do this part of the video in multiple parts, and it is quite heavy on numbers and it's also quite heavy on assumptions. So I'm going to kind of go through it. I'm going to explain my thinking as I go. You might need to watch the video a number of times, and then I'm going to pause it and kind of fill in the spreadsheet and jump to part two. And hopefully it all makes sense for you as we go. Let me just zoom in a little bit. Okay, I think that should be much easier for everybody. So right now, Onfolio has roughly 6 million common shares outstanding. There are, I think it's about 5.8 million, but let's just keep round numbers, it's a lot easier. There's also 6 million warrants outstanding with a $2.50 exercise price. These are from when we IPO'd. Um, so what that means is if somebody pays us $2.50, they can get one share of common. At the moment, the share price on the market is below 250, so nobody's going to be exercising. But if the price were to rise, let's say our share price was $3 or $4, a bunch of people would exercise, and that brings more money into the company. Um, there's also a $6 million convertible note with a 98 cents conversion price. So I'm just putting it as 6 million shares, even though it'll be a little bit more because it's 98 conversion price, not a dollar. And this is because of an agreement we already have in place. So I've made some assumptions. Right now in our pipeline, we have some pretty big businesses, some pretty strong businesses. I believe we could acquire around 5 million of EBITDA. Right now, Onfolio is around break even on an EBITDA front, so I'm just assuming we're starting from zero. I think we can acquire our way to having 5 million in EBITDA, and I think we would need $10 million cash to acquire that EBITDA. Um, that's based on what's in our pipeline. Now, that wouldn't be we're paying all cash up front. Typically, maybe we're buying $20 million worth of businesses, and we need to pay 10 million up front, and the rest will be cash paid later, sell a note, earn out, that kind of thing. So it might not work out exactly that way. I'm trying to use round numbers. Don't get too hung up on the specific numbers. That's kind of what I said in the disclaimer at the beginning as well. Let's just keep it simple to understand, because once you see how I'm thinking about it and how it should play out in theory, you'll kind of understand what I'm getting at. So let's say in order to raise that 10 million cash, we issue new shares at $1. Now, I think that's quite conservative because right now the stock is above a dollar. But let's try and be conservative. If I say we're going to issue new shares at $5, you're going to think I'm crazy. So I want to show that being conservative, it still works. So therefore, we would issue 10 million new shares. So this is where people are concerned, like, well, hold on, if you've got this equity line, are you going to be diluting and so on? And that's the whole purpose of this video. So what would that do? Well, let's assume the convertible note holders managed to convert all of their shares out. So now instead of 6 million common, there's 12 million. And then we issue 10 million more. Now there's 22 million. So pretty dilutive. And then let's assume the 6 million warrants are still there because the price is below 250. So, okay, what should that mean? And this is where it was very much theory crafting, and I'm really trying to make it painstakingly clear that I'm not promising this is what's going to happen. Um, First of all, I would get in trouble for that. But second of all, you shouldn't believe me if I say that. This is kind of like a working model. However, it is a very reasonable assumption. So let's say after we raise this $10 million, we issue these shares, we go out and we acquire our 5 million EBITDA worth of businesses. So Onfolio now has 5 million EBITDA. Now, what kind of multiple would the market value Onfolio at? This is again where I really can't make any promises. So when I say 15, I'm going to write here assumption so that it's really clear. Um, However, when you look at the comparables out there in the market, I think 15 is reasonable because smaller microcap companies of our size often actually don't have any earnings, so there's no real comparable. Um, some of the serial acquire businesses out there, like Constellation Software, Berkshire Hathaway, they all have a much, much larger multiple, I think like 30x. And then some of the others have somewhere in the range of sort of 8 to 20. So I thought, okay, let's just pick 15. The other thing is, if we grow faster, the multiple might be higher. If people believe we're going to keep growing, the multiple might be higher. Um, you've all seen, if you're an Onfolio shareholder, our stock went up very high the other day. It sort of comes back down. The PE multiple is just one thing, but it's kind of the anchor for this whole spreadsheet. So I had to pick a number. So therefore, our valuation would be 75 million market cap. So that is basically the market saying they've got 5 million in earnings. We think they deserve about a 15 times multiple. Therefore, 75, they're valued 75. So that's just 15 times 5. And therefore, we think fair value for the share would be $3.40 per share. So that is quite simply 75 million divided by 22 million shares. So you might be thinking, oh, like I bought into the price because I thought Onfolio was going to go to $10 a share or $20 a share. And I would say, well, this is just showing how the spreadsheet should work. As you can see, sometimes the value is much higher, sometimes it's lower. But this is how I think about issuing new shares and the impact it should have. So let's say now we were at $3.40. Well, I think maybe half of the people who own warrants would exercise their warrant. Some people will not exercise. They want to see the price higher. Some people actually, I own about 500,000 warrants. I'm kind of restricted from when I can buy and sell, so I'm not going to exercise straight away. So 50% I think feels reasonable. So that would bring in $7.5 million for Onfolio because 3 million, so 50% of the warrants, 3 million warrant holders exercise. They all pay 250 a share. So they have to send us 250 for every share they have. So we get 7.5 million. So let's assume that under the same ratio, here we said we need 10 million to get 5 million of EBITDA. So if we had 7.5 million, maybe we can get another 3 million EBITDA. That's actually slightly more conservative than 10 million for five. Sometimes we might buy a bigger business that we have to pay more for. Um, so what would that do to everything? Basically, now there would be 25 million shares because there's 22 and 3 million warrants have been exercised. And now there's only 3 million warrants outstanding. So our new EBITDA is 8 million, 5 million plus the three we just acquired. And let's say the market just keeps us at the same multiple. So now our valuation would be 120 million and our share price would be 480. So again, 120 million divided by 25. So even though there's been dilution, there's been new shares issued, the price went up because we used the share issuance to buy EBITDA. Therefore, it's accretive for shareholders. So um, your percentage ownership in the company will have gone down a little bit, but the value of that ownership will have gone up. So this is how I think about it. Let's assume at that point the remaining 50% of warrants exercise, because at this point it's 480. Warrant holders can make pretty good money. So I think everybody would exercise. So that would bring in another $7.5 million. And maybe this time we can only acquire 2 million of new EBITDA with it. So we're paying more cash up front or more expensive businesses, that kind of thing. So now there would be 28 million shares outstanding, and our new EBITDA would be 10 million. Let's say the valuation now is 150, so that would be $5.30 per share. Now, none of this happens automatically, but if everything plays out how it should, then this is what the price would be. Now, how long a period does this happen? Is this 6 months? Is this 12 months? One, I don't know, and two, that would be in making prediction. So that's what would happen if we basically only issued 10 million more, $10 million more worth of the facility we have. And we've got a 100 million facility. We also have a 300 million convertible note out there. So a lot of people are like, wow, great, the company is really well capitalized. But what happens if they issue more equity? Um, and I would say at this point, if we have 10 million in EBITDA, most of that would be free cash flow. Our businesses are quite asset light. Some of that cash is going to have to go to paying the rest of the money for the businesses we acquire. So, like I said, we're not, maybe we don't pay all cash up front. We say to some sellers, we'll pay you 50% cash now and we'll pay you the remaining money in a year or in 2 years. So some of this cash is going to have to go to paying them off. But at that point, if we're making 10 million a year in profit, we probably don't need to issue more equity because we're making 10 million. We've got cash to fund operations and additional acquisitions. However, what I want to quickly do is say, well, what happens if we actually use, say, 50 million more of the facility? Because that's where it gets quite interesting. And I think it's also where people get a little bit nervous when they think about us issuing that many more shares and they want to know, well, what should happen? So I'm going to fill out that part of this sheet and come back. Okay, so I just quickly added one more thing here. Um, so I thought, well, you know what? What if we do tap the equity line a lot? We do raise a lot more capital. What might that look like? So here's how I think it would play out. Now, in this scenario, our share price is $5.30. But what if, as the price is going up, we are tapping the equity line some more? And let's say we raise an additional 30 million. um, dollars. And let's say the average price we do it at is three, because maybe we do some at when the price is at one is at two, some when the price is at 350, four. The average price is three. I actually think that's quite conservative. We would probably be using it more, here. Maybe so maybe we would be able to raise 50 million for the same number of new shares issued. But let's keep it conservative and very easy to follow, or easier to follow. Hopefully, it's easy enough. So, in this instance, then we would be issuing 10 million new shares, which would make our outstanding share count 38 million. So, how do we get that number? Well, down here we're at 28 million, and we've issued 10 million new shares. So now we're at 38 million. Um, and again, let's say from spending that 30 million, we're only able to um, acquire another 10 million in EBITDA. So previously, every dollar of EBITDA only required $2 of cash. And what I'm saying here is we need $3 of cash. Why? Well, because maybe as the business scales, we need to pay slightly higher amounts for the business, or maybe we still have to pay back some of the seller notes from the other acquisitions. And again, I don't want to show you the kind of cherry-picked, most aggressive scenario. I want to show you maybe a more conservative scenario. So in this instance, we are at 20 million in EBITDA. So our new valuation, assuming we have the same multiple, is 300 million. So per share would be $7.80. So that would be uh, basically 300 divided by 38. Um, and so again, like even in a scenario where we raise quite significant amounts of capital and we increase our share count quite significantly, like we've gone from 6 million-ish as of today to 38 million. People might think, "Whoa, that's massive dilution," and but I would rather my equity. I have like 1 million shares in Onfolio, so I'd rather they're worth 7.8 million than 1.3 million. So that's how I think about it, and how I think most people would think about it. Now, there's a couple of other things that are interesting because at this point, if we've got 20 million, we might say, you know what, next year we're not going to issue any new equity. Or maybe we say let's keep issuing because it's very accretive. But let's say next year we say we're going to take this 20 million EBITDA and we're going to go acquire another 5 million, which again, that's really conservative now. That's $4 cash needed for every $1. So that means we're basically paying all cash for a business. So the share count wouldn't change. It would still be 38 million. Oops. So there's 30 million in EBITDA now. So the new valuation is okay, 450 million. So per share, that would be about 1180, 1184. So let's just say 1180. Yeah, now it's looking pretty good. And so this is kind of the model and how we're thinking about it. And as I've said a lot throughout this video, it probably won't work out exactly this way. So what happens if everything went badly and we uh, for some reason the market only gave us a 5x multiple? And I'm not going to go back and change all these other models. Let's assume we still raise 30 million and we pay an average of $3 a share, even though our share price is 260. You could make an argument that this model should all be updated. I'm just trying to keep it simple. If we only got a 5x multiple, but we had grown our way to 20 million in EBITDA, then instead of spending the next 20 million on more acquisitions, we would do share buybacks because we would think, okay, the ROI is clearly better in reducing these number of shares from 38 million down to 35 million or 30 or however many we can buy. And then as the price starts going up again, because we'd be buying, maybe we say, okay, now it makes sense to switch to acquisitions again. So it can also go a lot better than the model I've shown you. Like maybe once we start doing this, the market realizes what we're doing, that we're demonstrating that it's working. Maybe, maybe we get like a 20x multiple or a 30x multiple. Um, that's where things get really interesting. And the companies that do this really well, they do get those kind of multiples, and shareholders love it when they issue more equity because they're like, great, keep buying businesses at 4x and or 5x EBITDA and issuing new shares at 30x. Why would you not do that? It's accretive to everybody. So the only thing that goes down is your percentage ownership, which for most people is just not a concern anyway. So that's how I'm thinking about it. That's how it could play out. That's how the model works. And that's how, we'll know if it's working. Now, if it's not working, we can always say, okay, let's just buy back some shares, or we just keep buying businesses, having lots more profit and so on. But generally, increasing the share count is only bad if you kind of just don't drive growth in the business in the process of doing it. Whereas if you are able to keep growing your EBITDA, then the share price will eventually take care of itself because the market will eventually take notice. And if it doesn't, we buy shares back. So thank you for that for watching me go through this model. I know it may be um, quite technical for some of you, or you may want to poke holes in some of the things I've said, or you may want to ask a ton of questions. Feel free to. This is really just me sharing how we think about it, how you could think about it, and trying to kind of put a little bit of uh, visibility into what the future might behold. So, again, thank you.